Dividend Growth Investors, bonjour. My name is Mike Yeru and I have this YouTube channel to help you invest with more conviction so you can enjoy your retirement. Last week, we discussed 4 stocks on the Canadian market that has a dividend yield over 4% and still manage a way to increase their dividend every year. This week, we're going to do the same thing, but from the American market. So let's get started with Realty Income. One of my favorite REIT if you are looking for income and you don't mind too much about the stock price appreciation. So obviously, whenever you select a high yield, you will likely not get much stock returns, right? So it's just a matter of either the company keeps the money inside the business to grow it through R&Ds, marketing, acquisition, etc., or they give you back that money so you can allocate it yourself, or you can live off your dividend and then enjoy a peaceful and nice retirement. So Realty Income is one of the best REIT there is. More than 12,000 properties, single tenants, so very easy to manage, all about location. Most of their tenants are investment grade, so 50% of them are investment grade. So most of them are also what I would call Amazon proof. So they do not depend on e-commerce. They can fight back. They don't have those kind of problems, because this is one of the big problem in the retail business is many retailers has to now manage a mix of brick and mortar stores and also online presence. For Realty Income, they have a lot of companies offering services, or they don't necessarily have to deal with e-commerce, and therefore they are a little bit more strong on that aspect as well. What I like about Realty Income as well is its wide diversification. So they're across 50 states, but they're also present in the UK, in Italy, and in Spain. Obviously, if you look at the dividend triangle, you can see that the dividend is increasing, but like it's super slow. We're talking about like 2.5-3% per year, but it's very stable, pretty much beating the inflation most of the time. Not the past 3 years, but on an average over the next 10 years or over the past 10 years, it's pretty much in line with the inflation. So it helps prevent your buying power to decrease, and at the same time you can see it as a deluxe bond paying a yield over 5%. So it's quite generous, it's very stable, and it shows a very high occupation rate. So for all of those reasons, if you're looking for income, I think that Realty Income is a pretty good start for your research. Moving on to what was one of the COVID darling, Pfizer. So Pfizer were, like, as you can see on the dividend triangle, we saw revenue and earnings skyrocketing for their vaccines and all the drugs that are related to COVID. It was a great time for them. And then what happened? I mean, the stock reached like $60 and then going down to 35. That's kind of crazy, right? So 2 things happened. Obviously, there was a lot of hype around COVID, and now it's slowing down. We can see that revenue and earnings are going to decline in 23 because of that. And the other thing is they decided to make a major move. And whenever the market sees a major move like that, a huge acquisition, it creates a lot of uncertainty. So you don't know what's going to happen with the integration. We don't know what's going to happen with the debt. And we don't know if it's going to be a great acquisition going forward. So Pfizer is about to disburse $43 billion to buy Seagen, not too sure how to pronounce it. Sorry about that. I'm French, right? So it's a it's a business evolving around cancer drugs. Definitely good move for their pipeline. They see a lot of integration possible, a lot of synergy as well. And obviously, as any acquisition, management is super optimistic about it. The market, not so much. And this is where you can get a great healthcare business, a big pharmaceutical at a cheap price, but then there is definitely a risk that the integration doesn't go that well and the acquisition just bump the debts to a higher level and then creates more concerns. So I would call it as an educated guess. Over the history, Pfizer has been doing very well in terms of increasing its dividend. I think it's a very solid play, but then again, there's always a level of risk, and this is why you get this opportunity. There's a price to pay, risk reward. You have it with Pfizer at this point. Another big pharmaceutical offering you a yield above 4% is Abbvie. Abbvie has been one of my favorite play on the healthcare business. I do not have it in my portfolio though, full disclaimer. I just thought it was an interesting play because what happens with Abbvie, the interesting story here is they are seeing their price going down mostly because they lost all patents around Humira. Humira was their best blockbuster ever, was more than 50% of their profit. There was a big part of their sales, and as you can see, sales are now at the plateau. The earnings are going down mostly because Humira sales are slowing down, so it means less profit. And on the other side, the other drugs that are being developed, they have a very strong pipeline, but they're not able to compensate the losses of Humira at this point. So there was that play for a few years where we knew patents were going to expire. We were looking at other drugs coming up on the market, hopefully being able to compensate and offset those losses. It's not happening as fast as expected, and this is why right now we have this opportunity growing up. Another thing that Abbvie did a few years ago, and you can see that between 2020 and 2022, there's a big jump in the revenue, is because they spent more than $60 billion in the acquisition of Allergan. Allergan is known for the aesthetic solutions with Botox. So Botox is probably like the most known trademark brand. Actually, it's quite interesting because instead of having a patent on this one, they issued a trademark. So the formula for the Botox is not known as a classic for the drugs where you deposit the formula to get the patent. So they don't have the patent. Anybody could technically copy the formula, but they don't know what it is. So it makes them interesting. So they, on top of acquiring a nice asset, they also acquired like a lawyer's department office, which are a bit more creative. So that could pay off for new patents going forward and new ways to develop drugs and how they can be sold. Overall, on the dividend growth perspective, Abbvie has been a solid dividend payers. Obviously now it's going to slow down. So 5 years ago, we were expecting like 10% dividend growth rate every year. Now it has slowed down to roughly 5%, similar to what we had in 22. So do not expect this one to skyrocket in the future, but it is another very stable and generous dividend payer in the pharmaceutical business. Now moving back to the last one, which is Stag Industrial, another REIT. Why I've picked so many REITs over the past Canadian and the US one, it's because REIT are among the sector that has been affected the most over the past 2 years on the market, mostly due to the rise of interest rates. Stag Industrial, what is interesting here is they have mostly warehouses and distribution centers as properties. They have well diversified clients serving a bunch of different industries, and their occupation rate is over 98%. So they are developing new properties, but they are not still at the place where they have oversupply. So the demand for those type of properties is still very high. The occupation rate is high, and they have those escalator contracts where they can ask a little bit more from their tenants every year, so they can increase their leases. There's no problem. The dividend growth is there, but it's very, very small. So we're talking about roughly 0.75 to 1% per year. So it looks good on the graph, but when you look at the numbers, not amazing. You can see Stag Industrial most likely like a deluxe bond with a yield that is above 4% as well. It's quite stable. It is still increasing. The FFO payout ratio is around 90%, so it's a bit high right now. Hopefully it's going to be able to be maintained and to go a little bit lower at one point, but overall it is definitely a sleep well at night stocks. I just like the industrial REITs at the same at this point where they got hurt due to their sector, but in general their business is still doing very well. You can see revenue continues to increase as well, so I'm not too worried about this one. If you want to know, if you want to get more stock ideas like those, I have built the Rockstar list. This is a list that is provided you by email in an Excel spreadsheet, so you can play around. You have like multiple metrics that you can filter, and this list is being updated monthly, which is kind of cool, right? It's free list. You get like roughly 300 stocks, both Canadian and US, and I provide you with the what I call the strongest stocks because they show revenue, earnings per share, and dividend growth for the past 5 years at least. It is a great starting point to look for new stocks ideas for your portfolio to start digging. Obviously, you cannot just pick one and close your eyes, but if you want to narrow down your choice and select about companies that have strong fundamentals, this is definitely a good starting point. So the link is in the description below. You download it, it's completely free, and you can thank me for it later. Let me know if there are any other high yielding stocks, both on Canadian and on the US market, that you like. We can discuss that in the comment below. Give me a thumbs up, follow the channel, and until the next week, don't forget to stay invested.